Have you ever wondered how one of the world's most powerful financial hubs began with just a handful of traders gathering under a tree? Today, Wall Street conjures images of skyscrapers touching the clouds, trades completed in milliseconds, and fortunes shifting by the billions in a single day. But rewind to the late 1700s, and you'd find a humble street in Lower Manhattan, where transactions were as informal as they were chaotic. Rumor often mattered more than fact, and no central authority existed to protect investors. Everything changed on May 17, 1792, when 24 merchants and stockbrokers signed the Buttonwood Agreement. That moment, a short contract inked beneath a buttonwood tree, sparked the rise of the global financial empire we know today. Picture post-Revolutionary War New York, a bustling port city grappling to stabilize its economy. There were no unified regulations, no common pricing structure, and certainly no official exchange to keep speculation in check. If you wanted to buy or sell government bonds or shares in an early bank, you might wander to a tavern or a coffee house, searching for someone shouting prices into the open air. News traveled slowly, and in such an environment, unscrupulous players could inflate prices at will, leaving unsuspecting buyers with worthless paper. The Buttonwood Agreement put a stop to that uncertainty. Under a buttonwood tree on Wall Street, 24 signers pledged to trade only with each other and to adopt fixed commissions, curtailing fraud and giving the market a sense of order it had never had. It might sound exclusive, but this arrangement introduced accountability. Anyone who cheated would lose the right to trade with this circle, effectively closing off access to the best deals in town. Why a buttonwood tree, you might ask? In the late 18th century, Wall Street was no grand financial district. It was simply a stretch near the southern tip of Manhattan, dotted with modest buildings and open space. The tree served as a natural meeting spot, easily recognizable and inviting. Standing outdoors in plain sight symbolized a new era of transparency, shedding the secrecy of backroom haggling. With this agreement in place, investors felt a surge of confidence. No longer did they have to worry that a smooth-talking broker might vanish after artificially pumping a stock's price. In a way, the group acted like a club with membership rules. Break them, and you'd be shut out from trading, damaging your credibility overnight. So what did these early markets trade? Government bonds were a major staple, helping the newly formed United States fund its war debts and public infrastructure. Banks and insurance companies also offered shares, giving ordinary citizens a stake in these important financial services. As more businesses discovered they could raise capital by listing on Wall Street, the marketplace grew, steadily turning New York into the nation's financial hub. At first, trading was anything but high-tech. Men scribbled numbers on chalkboards, deals were recorded by hand, and someone literally had to shout out the latest prices. There were no telegraph lines, let alone electronic quotes. So if you wanted real-time updates, you had to be physically present or pay someone to deliver the news. Still, the Buttonwood Agreement's principles of fairness and mutual trust gave rise to a legitimate, recognized market. By 1817, the group became the New York Stock and Exchange Board, which would eventually evolve into the modern New York Stock Exchange, NYSE. As the 19th century unfolded, America's economy exploded in scale, and Wall Street rode the wave. Railroads needed huge sums for tracks, engines, and land. So they issued stocks and bonds to a public eager to invest in the transportation revolution, connecting the nation. Factories multiplied during the Industrial Revolution, and they too needed large pools of capital for equipment and labor. That money flowed in from Wall Street, fueling industrialization and generating vast fortunes for those who timed their investments well. Of course, not all was smooth sailing. Market panics erupted in 1837, 1857, and 1873, each fueled by overconfidence, buoyance, questionable lending, or abrupt swings in economic sentiment. Investors who had soared high on speculation found themselves penniless when stock prices plummeted. Yet each crisis led to some degree of reform or self-imposed caution, allowing the market to recover stronger than before. No meltdown, however, equaled the crash of 1929, which set off the Great Depression. Throughout the Roaring '20s, millions believed the stock market could only rise, so they borrowed heavily to buy shares. When prices collapsed on Black Tuesday, October 29, 1929, billions of dollars evaporated, banks failed, and unemployment soared. For the first time, the U.S. government intervened comprehensively in the financial markets. The Securities Act of 1933 and the Securities Exchange Act of 1934 introduced mandatory disclosures. and the Securities and Exchange Commission (SEC) was formed to watch for insider trading and fraud. Some claimed these new rules saved capitalism from itself. Others argued it restrained the market's natural dynamism. Regardless, Wall Street would never again be left to its own devices. In the decades that followed, technology brought constant change. The telegraph made it possible to send prices more swiftly. Ticker tapes allowed traders to see updates without shouting across the room. And eventually, computers took over, enabling lightning-fast trades. By the 1980s, leveraged buyouts and corporate mergers created dramatic stories of power and wealth, illustrating both the high rewards and high risks inherent in finance. Then came the 21st century, where globalization turned stock markets into interconnected webs. A Federal Reserve policy tweak or a corporate earnings report in New York could now shake confidence in Tokyo or Berlin within hours. NASDAQ rose as a formidable competitor, attracting cutting-edge tech companies like Microsoft, Apple, and Amazon. Each new wave, whether it was the dot-com boom, the housing bubble, or the subsequent crashes, showed that the market could still veer into reckless optimism and then crash back to earth. Even so, the foundational idea of a marketplace governed by a shared set of rules, set in motion back under that Buttonwood tree, remained central to how Wall Street functioned. The question people often ask is whether Wall Street has strayed too far from those origins. Has it become an unwieldy behemoth, reliant on complex derivatives and swift speculation that can destabilize entire economies? Or is it still the core engine for funding innovation and expansion, fueling the world's largest economy while opening doors for global investors? Critics point to incidents like the 2008 financial crisis, where mortgage-backed securities and predatory lending collapsed the system, forcing massive bailouts. They argue that greed and complexity overshadow the principles of transparency and fair play. Supporters counter that these markets, when properly regulated, provide an irreplaceable method for businesses to obtain capital, governments to issue bonds, and entrepreneurs to transform ideas into industries. Meanwhile, the average person can now download an app and participate in real-time trades, a far cry from the days of chalkboards and face-to-face shouting matches on the exchange floor. But beneath the algorithms and electronic screens, the essence remains: a network shaped by written agreements, trust, and the expectation that the market must be fair enough to attract widespread participation. Those 24 men who gathered under the Buttonwood tree might be astonished to see how far their vision has come. Yet they'd likely recognize the fundamentals: centralization, shared guidelines, and the mutual desire for legitimacy continue to guide millions of trades each day. So the next time you watch stock tickers scroll by on a financial news channel or hear about a company's IPO on the New York Stock Exchange, take a moment to remember that it all started with a simple pact on a dusty street corner. It was a pact that gave birth to regulations, investor protections, and the notion that American capitalism could and should be an organized endeavor, not a chaotic free-for-all. That's the legacy of the Buttonwood Agreement, turning raw speculation into a structured marketplace, forging a path for rapid industrial growth, and eventually evolving into a behemoth that wields global influence. Want more business and finance breakdowns like this? Subscribe to Biz Daily Digest for deep dives into strategy, finance, and economics. Hit the like button if you found this interesting, and let me know in the comments. Do you think this transformation was inevitable as America matured, or did that small agreement under a tree truly ignite the spark that still lights modern finance?